according. Okay, and this holding period return is the difference between the two prices and the dividend along the way, and then divided by the beginning price. So this whole thing can be decomposed into two parts. Part of it is the capital gains yield, and second part is the dividend yield. Okay, so if you take the ratio, this part is the capital gains yield, and the other part is the dividend yield. So we did that in the past class. We talked about the averages, the APR and EAR, equivalent effective returns. We talked about last time the nominal interest and real interest. Okay, so that really, when we're talking about is the Fisher equation. Okay, so we can see that the actual effect is more of a compounding issue, if you will. So if you multiply both sides by 1 plus RI, then we can get 1 plus R times 1 plus I should be equal to the total compounding effect of 1 plus nominal return. So this whole thing, it should be more than, if we expand all these brackets, it will be more than just this R plus expected interest, the inflation. However, according to the Fisher's equation, it's pretty much a simplification. So that's a abbreviation of the proper one. Okay, and say approximately, basically approximately, these two should still be approximately equal to whatever we see previously. So previously, if we had 1 plus R, it should be equal to what? 1 plus R plus expected I. And you have another term, if you expand the brackets, that should be the R times the expected I term. Okay, so this term argued by the Fisher equation that should not be mattering that much. Why is that? Well, if you think about the real rate, it's kind of low, usually 0.02, 0.03, a couple of percentage points. Then expected inflation is not going to be sky high either. So if you multiply these two, you're going to see a number in the magnitude of 0.0 something %. That makes sense. So the whole thing will be fairly small. And that's why, according to the Fisher's equation, say, okay, if we really make this approximation, we're not going to lose that much. And that's why we say, oh yeah, if we take away this one and we take away this one, so approximately this R should be equal to the real rate plus expectation of the inflation. Be very careful that you are talking about the current expected inflation, because these returns are the forward-looking ones, namely from time now, you're looking into the future. Okay, we want to make sure that these expected inflation are also forward-looking instead of calculated a calculated figure, calculated data point from the history. So instead of looking at that, we are going to look at the forward-looking inflation as well. Okay. So we also looked at historically what was happening and when, and that got us into a kind of healthy little chatty about what was going on historically, and something I have done in the investments and things like that. So one thing we haven't thoroughly explored, we kind of mentioned it last time, was the scenario analysis and probability distributions. Okay, so we all understand this. A scenario analysis, what about we are going to have this happen? Okay, typically we have the most coarse ones we can think about as Say, for example, if the Fed is going to increase the interest rate or the Fed is not going to increase interest rate, right? So if we have our nominal rate is going to go up or nominal rate is not going up or like being flat. So, well, most likely they're not going to drop it for the near future. And they've been talking about increasing it and they're going to shrink the balance again. So if we see this, we're going to think about, first of all, if the Fed is going to bump the interest rate up, what's the consequence? And that was what my question was. It was a big question trying to prompt you to get into the muddy world of forecasting. Basically, what is forecasting? It's an educated guess, right? So it's essentially you're guessing what's going on in the future. So at first it would be like, oh, I don't know what the correct answer is. The truth is nobody understand what the correct answer is, right? So all you have to do is you have to think real hard and think about what's going on and make your own guess based on your own rationale. So there are people who are guessing better. These are mostly who have been calibrating their model and theory using historical data for a long time. So at every single time point in the history, they are going to pretend they only knew all the information up to date and made a forecast and use a strategy based on that forecast. And that's what they're going to do from then on, right? So they test this kind of strategy. This is what we call the back testing. Okay. So from back testing, they can know how they are going to calibrate their forecasting ability. So with the scenario analysis, you are going to guess what's going to happen according to each scenario. And on the other hand, you are going to guess what is the probability distribution of each one. You can see that it's not an easy job, and that's why it's so hard to work in this financial industry. Okay, so just like I said, probability distribution is the possible outcomes and each outcome with its corresponding probability. Okay, so that is what we call the probability distribution. So if you go outside and say, oh, it's really going to be a lot of traffic on 59 right now, and I am going to take my risk and hop onto HOT, even if I'm not allowed to. See, I'm the only one right now, right? So then what is the probability distribution? What is the probability distribution of the outcome? Then you have to define the outcome, right? So basically say if you get caught, you're going to get fined negative, I don't know, you're going to pay $200, $300, I don't know, $500. There's a possibility that you could not get caught, right? So in that case, what's your payoff of not getting caught? So there might be an economic consequence on it and things like that. So all you need to do is you need to figure out all the outcomes, all the possible outcomes, and the corresponding possibilities. Okay, so typically in our model, when we are talking about the probability distribution, we think about the possible outcomes as the expected return for each scenario. Okay, so basically you're going to have, let me share a whiteboard. You typically have scenarios, and 1, 2, 3. Each one will have their own outcome, and these outcomes are, in our case, typically a different kind of return. So return you'll get in scenario 1, return you're gonna get in scenario 2, return you're gonna get in scenario 3, and you are going to pair these with the probability of each scenario happening. Say the probability of dropping okay, 10%. Probability of keeping flat, 30%, and 60% of probability of going up, something like that. Okay. As you can see, when you're talking about these scenarios are situations. They're not necessarily numbers. We're just labeling them case 1, case 2, case 3. These are not actual numbers. However, if we want to calculate the expected return, then you will have to first figure out the outcome as the numbers and probability as the percentages. The probability has to all add up to 100% or add up to 1. Okay, so that's when you are going to get the expected return. Let's see, where will we? Switching back to. So, in one sense, this expected return is a mean value of the distribution. Why is that? Well, if you think about it, if we have some outcome that is having a high possibility of getting it happening, sorry for the crappy outcome. Okay, so this one has a high probability. What does that mean? Well, it's very likely it will happen. Okay, so do you want to, the question is, when you're thinking about the average or the mean value right here, do you want to kind of assign more weight to things that are most probable to happen? And that's the underlying logic. Okay, so when we are not doing the simple average, instead we are going to do a weighted average with the weight being the probability of each scenario happening. We are effectively giving those outcomes that are more probable to happen is more dominant value, more impact on the final mean value right there. Okay, so if we are going to have the distribution of the holding period return, remember what is a distribution? The distributions are outcomes together with its corresponding probabilities, right? So you're going to have a bunch of outcomes and then a bunch of probabilities. So if it's a distribution of HPR, the holding period return, then what are the outcomes? Well, the outcomes could be anything from negative infinity to positive infinity. In real world, it probably won't go to infinity, right? Because you have limited amount of time. Whatever result, negative or positive return is going to be finite. But it doesn't hurt to extend the model a little bit, even if the chance of that happening is infinitesimal. So we have that, the possible outcomes as the whole range of possible HPR, and the probabilities then is what we usually are thinking about when we are thinking about the bell curve or the probability of the return happening. So that is combined together to be the probability distribution right there. Okay, so now we have the mean value. We also want to know the variance. What does variance tell us? When we talk about the risk and return, right? So we have risk and return, and the risk and return always come in pairs. So the risk, the return itself, we have already taken care of. That is the expected return. But for the risk, we are going to use what? Variance, and also the standard deviation that comes from calculated from the variance. So how do you calculate the variance? Variance is basically the expected value of the squared deviation from the mean. Okay, first of all, well, yeah, it makes sense to have some kind of deviation around here, right? We're gonna see uh, if this is the mean, if it deviates a lot from the mean, it will be more risky. If it deviates less from the mean, it will be less risky. So all makes sense. However, on the other hand, why do we need to get it squared? What if it's not squared? Okay, so we pause this, think about it for just 1 minute. If it's not squared, then you add up all these deviations. Notice that some of them are positive, some of them are negative deviations. Then what will happen? Oh, a lot of them can net to each other and to be zero, right? So you really cannot see, if you have -1, +1, -5, +5, sorry, or compared to -1, +1, -1, +1, which one is more risky? You don't know if you don't square it. If you don't square it, these are all going to add up to be what? Zero. All these deviations from mean is going to be zero. So you have to square them, and that's when you are actually looking at paying attention to how far it is that it deviates instead of paying attention to is it going positive or the negative, or the direction of it being deviation. So that part, the deviation part, will make it as the measure of risk. Oh, my handwriting looks awful here. Okay, and the return is taken care of as the mean of the whole interior return. So we have the whole pair of risk and return. Okay, so another risk measure is the standard deviation, which is nothing more than a square root of the variance. Why do we want to have the square root? Because remember, somehow you squared it during the process, so the whole dimensional thing is going to be exaggerated, right? So if you started with percentage, now you are squaring it, it will make 2%, like it's percentage square, something like that. But once you take the square root of that, it becomes coming back to, it's transformed back to its original scale. So that will make sense. Okay, so scenario analysis. If we're talking about a specific one, then we can see in this particular scenario, we could have severe recession, mild recession, could have normal growth, we can have a pretty good time. By the way, what do you think right now? Okay, so if it's very bad recession, then it's going to drop, return's going to be negative. Mild one, -11, normal growth 14%, and boom, will be 30%. That looks like a good stock market analysis, reasonable numbers. Okay, so what do you do next? Well, the next thing you are going to do is you're going to take a weighted average of all these HPR, and you are going to take the probability as the weight. So what does that mean? It means that you are going to multiply 0.05 to this -37, 0.25 to this -11, and so on and so forth. And then you are going to get, from multiplying the first two columns, you're going to get -185, -275, so on and so forth. So if you add these all up, you're going to get 10, and that is your weighted average. Why do you all add it up and without dividing anything? Don't you usually take an average by dividing something? well then you are going to divide the whole thing by the sum of all the probabilities, which is equal to 1. Exactly. So if you do that, you're still gonna get 10. Okay. So deviation from the mean return, that is taken from 37, let me change another color, from the negative 37 from the negative 1.85. That makes sense. Oh, sorry, the negative 30, sorry, I'm so sorry. Okay, so let me erase all this. Now let's start from here. So in order to get the deviation from the mean return, what is the mean return? Mean return is the 10%, right? So if its HPR is negative 37, its deviation from the 10% is what? Negative 47. What about negative 11? That gets to negative 21. What about 14? 14 minus 10%? 10% is going to be 4%, so on and so forth. So the deviation are all these. And what about the variance? Remember, you need to square it, right? So you are going to square the deviation, and that takes away all the negative sign and make it everything positive. So if you add them all up, okay, so that will give you 120, okay? And then no, sorry. If you square them all up and then multiply by the probability. Okay, so if you take this squared, multiplied by 4.05, okay, that's going to give you 110.45 and so on and so forth. So then you add all of these column B, this is a column B, oh, this is a column B, okay. This column B times square deviation, add them up, you're going to get 347.10, and square root of that is an 18.63. Notice that the variance actually looks very big. However, when we take the square root of it, and the standard deviation looks like a normal percentage number of a return. So this distribution then has an expected return of 10%, and then the standard deviation, which represents the risk, of 18.63%. Okay, any questions so far? Okay, so for the normal distribution, I'm going to leave this part as a tiny little part until next class. However, I'm going to instead start talking about not this one, the Sharpe ratio. Okay, so let's talk about the Sharpe ratio first before we even talk about the normal distribution, because the normal distribution sometimes are confused with the Sharpe ratio, and most of the people would assume that the Sharpe ratio either is relying on the normal distribution or have the similar form. It is having a similar form there, but their meaning is totally different. Okay, so what is the Sharpe ratio? As we all know that when we talk about the risk, okay, and the return, then a part of the return is from the risk premium. And what are the risk premium? What is the risk premium? And risk premium is basically the kind of compensation you want to give people in order for them to be willing to take on a certain amount of risk, right? So if you're not going to give them any reward, then nobody wants to take on any risk, because people are all risk averse. Okay, so if people are not risk averse, if you're talking about, say, casinos, then there will be no risk premium. The risk premium is from the risk aversion. Okay, so now the whole return can be decomposed into part of it as the risk-free rate, and the other part is the risk premium. What kind of risk premium is it? Well, all sorts of risk premium, and we're just going to talk about them all together. Okay. So once we get that part straightened out, then we are going to ask one question and say, well, in terms of the risk and its return trade-off, is it a really good investment for me? Or basically you're asking the question, are you getting the value for the band? Right? So if you go out to buy any appliance or any major purchases, you're not just judging the price from the price alone. If I tell you, oh, this refrigerator is $2,000, do you think it's expensive or do you think it's cheap? Well, it all depends on what kind of preference you have, first of all, what kind of price point you're looking at, what kind of functionality you're looking at. So a $2,000 refrigerator, it could be a really good value. It could be a fancy brand that is originally marked at $4,000, now marked down to 50%. Or it can be something beefed up. So it all depends on the value, how much of value you're getting for your money, right? The same thing as when we are talking about risk and return relationship is because everybody is risk aversion. We want to get the most return out of the possible risk that we are taking on, as much of it possible. So ideally, we want to take as little risk as possible and then get rewarded by as much return as possible. So everybody got the idea right here? Okay. So based on that kind of thinking, we're going to first measure and say, oh, first of all, how much is my risk premium? Okay. Then portfolio risk premium is basically the whole portfolio expected return minus the risk-free rate. Why? Because expected return has two different parts, risk-free rate and risk premium, right? So one part is the risk-free rate. The other part is for the reward for taking on any additional risk on top of that. If we take that risk premium and we want to take the ratio of that risk premium to the risk that we are taking. So basically this ratio tells us how much of the premium or the reward we are getting for each unit of risk we are taking. And that is the Sharpe ratio. It's also called the reward to volatility ratio. Okay, so it is a very, very important idea because if you go out to talk to people, then most of the seminars and people, when they're pitching, they sometimes show you, they sometimes don't. A lot of times they just try to impress you with their return figures, and they are not necessarily talking about how risky their portfolio is. And that's totally wrong, because in the following chapter, we will talk about how we can magnify the risk or leverage, using borrowing. So if you are just for the sake of high return, you are taking on a lot of risk, I can always take the same amount of risk and get more return than you are doing, because if I have a Sharpe ratio, then have a higher Sharpe ratio than you do. Okay, so historical Sharpe ratios, we can talk about it. Small stocks are typically 0.37, around 0.4-ish, a little less than 0.4-ish. Okay, bonds, a little bit lower. Large stocks can be higher in the earlier year, but will kind of fluctuates. That is the whole world market. Okay. For the US market, then it was a while when the long-term treasury got negative. But overall, if we're talking about the Sharpe ratio, the treasury is pretty much give you the same bang for the buck for the large stocks. Okay, so, well, how do we define all these world large stocks, US large stocks? Then this is the definition for the world large stocks. We're talking about the 24 developed countries, over 6,000 stocks. The US large stocks are SP 500 largest cap. Okay, then US small stocks usually would take on the smallest 20% on NYSE or NASDAQ and AMEX. The world bonds in the same countries as the world largest stocks and US Treasury bonds are the Barclays Long-Term Treasury Bond Index. Okay, then the return that you are getting, however, you can see is very different. And the geometric average ranging from what? The 8%, 5%, 11, 9, 5, 9, and 5, all of these, right? Then what about the lowest return? The lowest return can be negative 39, negative 13, negative 54, and then the highest return can also be very different. As you can see, although these returns are not the same, the Sharpe ratio is around the same area. Okay, you see the point? The fact that you're having on average a higher return, I'm not talking about like over 30 years in total, I'm talking about 30 years average of, for example, annual return, right? Then you are going to get approximately the same Sharpe ratio, because the higher return you're getting is essentially from taking on higher risk. If you look at the figure, it will look a lot clearer. If you're talking about the large stock, it fluctuates a lot. And then if you're talking about the long-term T-bonds, it fluctuates not as much, but in this whole area, it's almost the same as the large stocks. And for the T-bills, it's a lot more quieter. Okay. And remember when we are talking about it previously, the same Sharpe ratio, we're talking about this one and this one. We're not even talking about T-bills. Why? Because T-bills is too short term and expires in no time. And that is another group of the things when we're talking about asset allocation. The T-bills, remember when we talk about in chapter 1 and 2, T-bills are a part of what the money market, right? So okay, asset allocation across the portfolios is the next topic. So we understand the risk, we understand the return. Now, if we want to have an overall return, then we need to somehow have a portfolio that's going to give you the appropriate risk and try to optimally allocate your capital between the risk-free or money market and the risky assets. So the asset allocation, the first question is between the risk-free one and the risky assets. And then among the risky assets, we're going to talk about bonds, and yes, bonds are risky assets, and stocks and everything else and within that allocation. So this is in earlier when we were tested, this is a bottom up or top down. This is the top down approach, right? So what is classical textbook definition of asset allocation? Is a portfolio choice among broad investment classes. So basically picking what to what. Then a complete portfolio then is including risky and risk-free. Capital allocation is the choice between the risky and risk-free assets. Okay, so risk-free assets are money markets, treasury stocks, price index and government bonds, money market instruments, risk of CDs, and usually, okay. And the question of a portfolio asset allocation is essentially, first of all, we're going to calculate the expected return.